Hello everyone, welcome back to our channel. Today we have a very special guest, Suresh Ji. Suresh Ji is the CEO of Baroda BNP Paribas Mutual Fund. We are here today to discuss your Balance Advantage Fund, which has just completed 5 years of operation. Congratulations, Suresh Ji, on this milestone.
Thank you, Sudhir. Delighted to be with you.
Absolutely, sir. Why do people call Balance Advantage Fund as an all-weather fund, sir?
So, one thing that all of us talk about is the power of compounding in equity. Now, all of us know that equity over a period of last 10 years, 20 years, 30 years has generated very strong returns. The trouble with that, however, is it goes through its own share of volatility. The markets delivers return, but never in a straight line. And to be able to make money from market, you need to have a bifocal vision. Stay bullish on long term, but survive the short term. And the only way you can make money over long term is by living through and staying the course through the short term. Now, sometimes what happens is the equity market volatility can be unnerving for people. A balanced advantage fund gives you a much better vehicle to weather the volatility. And it makes asset allocation automatically for investor depending upon the market cycle. So it does two things. One, smoothens your journey in terms of volatility compared to a pure equity fund. Number two, it allocates money to equity or fixed income based on the market conditions. Therefore, you don't have to do frequent switches. The fund does it for you.
Right.
Often we won't have nerve to buy at the bottom of the market or at the time of COVID, or let's say after a war has taken place and stuff like that. So that becomes unnerving for people. But if you're invested in this kind of a fund, we automatically raise the exposure of equity at such points of time to take advantage of the market conditions. And at the
Right.
same time, the markets are becoming very exuberant. We reduce the equity exposure and go defensive. Now, all of us are human. We have our own biases, and that is why to eliminate that, one of the things that we tend to do in Balance Advantage Fund is have a model which allows you or which gives you signals in order to give you a very clear idea about is this the right time to be raising equity or is it the time to be reducing? What should be the allocation between the risk-free and the risk asset class? So basically, just to sum it up, I said multiple things, but one, it is an automatic asset allocation devoid of human emotion and therefore driven by data. Number two, as you're allocating your money between equity and debt, the volatility tends to be significantly lower than the volatility of pure equity market. Yet, by actively allocating between these two asset classes, you are able to capture a good part of the equity market return with much lesser volatility. So it basically gives you a much better client experience and allows the client to hold on for a longer period of time.
Absolutely. So one advantage which I could think of, sir, there are many people who are very actively managing their portfolio. So rather than doing that, rather than buying at the low and selling at the high, nobody can time the market right? And also there are taxes involved when you switch funds over. So rather one should invest in this kind of fund rather than doing all the buying, selling themselves, because there is a fund manager who's doing everything for them.
That's right. So one is fund manager who has probably access to a lot more data as
Absolutely.
what we would have individually. And number two, also, it does it in a much better tax efficient manner because you are not really pulling out money from one fund and putting somewhere else. Otherwise, there will be a tax incident at every transaction. There'll also be an exit load at every level.
Right. So two key advantages which I could figure out is one, there is a fund manager who would not be biased on his buying and selling, and second is tax advantage when you buy and sell is what you can get in a balance advantage fund. So what is the ideal investment horizon for a balance advantage fund, if I may ask? What is the, if I would say on the lower side, is 3 years a good time to look into a balance advantage fund, or minimum 5 years you would suggest?
I would say 3 years should generally work for most people. If you're looking at pure equity, then we tend to advise more like 3 to 5 year horizon. But a balanced advantage fund about 3 years should generally give you a good experience.
Okay, okay. And sir, how do market fluctuations affect the mutual fund industry? Now I'm talking about the mutual fund industry as a general. And how does fund managing team at Baroda BNP Paribas adapt to these changes?
Sure. So I think we are a market linked product. And as a result, there are times when markets go through a super bullish phase, and there are times when markets are bearish. And that affects us in two ways. One, of course, is since our value is always stated at the market value of securities, our assets under management will fluctuate a bit with the market. But more importantly, client flows also tend to fluctuate a bit. So that's what typically happens. For us, and what we do at the mutual fund, I think our investment philosophy as well as process is relatively simple. We have a philosophy called BMV, Business Management Valuation. That's the framework that we use. And we believe that individual stocks make money and not the markets per se. So our focus always tends to be on companies. And we spend a disproportionate amount of time just analyzing the companies because that's where we find find compounders for you over a long period of time. B stands for business, M stands for management, and V stands for valuation. These are the top three criteria on which we analyze the companies. And if that meets a filter, then it is eligible for us to invest in. And irrespective of the market situation, we would always be able to find some companies which will be attractive for us to invest in.
Okay, okay. Now coming to the debt part of it, sir. I've seen a very interesting data point. Your as per the last month, why does your balance advantage fund has a relatively lower average maturity, which was 3.37 years, but they are still offering a higher YTM, which is 8.13 compared to the peers in the same category. What is your debt fund selection strategy, sir?
Sure. So the debt has a very important role in the balance advantage fund because willy-nilly the index has 50% debt and 50% equity. In our own experience in this fund, our average equity exposure over the last 5 years has ranged at around 55%, which means that about 45% went into debt. And therefore, it's important to manage that carefully and manage that well in line with what the market conditions are. Average maturity being lower is reflective of our view, where we believe that rates environment is yet a little volatile. And therefore, it is better to stay long at the shorter end of the market than longer end. Secondly, there are no risk premiums available. So if you really buy a 3-year security today or you buy a 10-year security, yields are virtually the same. Difference being that 10-year security comes with much more volatility.
Absolutely.
So why should I expose my investors to a volatility on fixed income when they're already exposed to the volatility of equity and I am not even getting paid for it? So very simply put, the debt exposure in terms of the maturity is at the middle end, 3 years, 4-year kind of a range, where we believe the returns are attractive as well as the volatility is not too high. Now, YTM being 8.1% is also a factor of we being very focused on managing fixed income effectively here. Rather than just putting some money into treasury bills or which are 6.5%, we have gone ahead and put together a corporate bond portfolio of strong companies which delivers these kind of return. So none of the companies in the portfolio will be below AA. So it's a combination of AA to AAA companies in the corporate sector, which deliver us a decent, steady performance and gives a good, consistent return.
Great, great. So moving to a different asset class sir, altogether, your allocation towards REITs and InvITs appear nominal in balance advantage fund. So could you clarify the role of these assets in balance advantage fund?
Sure. So REIT and InvIT is something that we have started investing over the last year plus. And we have got dedicated analysts to analyze this sector. This is a very interesting asset class, which has got better payoff metrics compared to traditional fixed income. And at the same time, the volatility is not too high. So these asset classes like REIT combines a good current income with a potential for capital appreciation, because as your rentals keep rising every year by 5% thereabout, the REIT prices should also generally rise to reflect that. In case of InvITs, there are very interesting opportunities where there are a lot of infrastructure developers who want to downsell the portfolio because they want to go and develop another infrastructure project. So both in REIT and InvIT, there are developers who are looking to sell down their existing well-performing stabilized assets, which are giving consistent return, so that they can free up capital to develop another building or another infrastructure project. And which is why these are assets available at very attractive yields. We have found this segment attractive, and we have taken a measured exposure to multiple securities in this area. We believe going forward, this segment of the market will grow significantly, and we are well positioned to invest further here.
Great. And what is the primary target audience for a balance advantage fund, sir?
Everyone, you, me, or anybody who wants to invest anywhere between 5,000 rupees or even lower for a medium to long term. So this is a fund which is basically, I would say, a good entry vehicle, even for a first-time investor, because this fund delivers you a good performance of the market in a relatively low volatile fashion. If I were to give you an idea about our fund itself, we launched this fund in 2018, and as you said, we are just about completing 5 years now. And over the last 5 years, through the market, we have seen equity market point-to-point return being around 90% thereabout. And fund has managed to deliver about 90% participation, almost 90% plus return of Nifty. But our average equity exposure through this period was only about 55%. So what you've got is a significantly lower volatility because of the fact that you're 55-45 large average on the portfolio, but at the same time, you've got returns which are fairly close to what Nifty has delivered. So you've got good return with low volatility. Now, how did we manage to do it? Is by actively moving, participating in the rising market, but at the same time defending our position in a falling market. So therefore, if you really look at our equity allocation, there have been times when we have brought down the equity allocation to as low as 35-40%. And there are times when, like COVID period, where we raised the equity allocation to as high as 87%. So when the markets are performing well, you raise the equity component, but at the same time, when markets are expensive and you expect market performance to trend down, you become slightly defensive and you reduce the equity exposure from, let's say, 70-80% down to 30-40%. And because of this asymmetric payoff, where you are participating better in the upside and at the same time losing lesser in the downside, you manage to capture a good part of market performance without getting too negatively impacted in the downturn. It will impact, just to be very clear, in a downturn, we would lose some money, but at the same time, it will be significantly lesser than what a pure equity fund would do.
Absolutely.
And as a result, as a combination of the two, you are able to have a much smoother journey, as well as get almost the entire performance of the equity market.
So, Suresh, you've spoken about different asset classes so far: equity, debt, REITs, and InvITs. Looking ahead, uh, is there any innovative strategies or any features that investors can expect from a balance advantage fund in the future? Are there any new developments or initiatives in the pipeline as an industry as a whole, or if we talk about specifically Baroda BNP Paribas, when it comes to a balance advantage fund that they would be investing in a different asset class as well?
Sure. So I would say I think we are relatively one of the few players who have actually invested in REITs and InvIT as a category. And we believe that that is a potentially a very attractive category, which will see a lot of availability of assets as well as good returns for the investors. India has a very large chunk of ready developed roads. For example, NHAI has been building, let's say, about 50 kilometers plus roads every day. They need to sell it down so that they can build another road. And therefore, these roads are in turn transferred or sold to people like or portfolios like InvITs, where it generates a return of government security plus about 200 to 300 basis point to them, which is far better than what you can get in a fixed income security. But at the same time, it might be a little lesser than equity, but does not have the volatility that equity delivers.
Right.
Similarly, if you look at the commercial real estate space, there the rental yields tend to be about 7 to 7.5%, but the rentals keep escalating every year by about 4 to 5% because most of the offices have that kind of a rental escalation. And that again creates a very interesting payoff where you get about 4-5% appreciation every year. As the rentals rise, your capital value keeps rising. And at the same time, the return of about 7.5% is a regular coupon. So you get almost about current government security yields as regular coupons plus a scope for appreciation. So these are interesting asset classes, which I think mutual fund industry is yet underexposed to. We have started working in this direction and we have a team in place which analyzes it. And that allocation, I would say, will keep rising. Now, coming to the product features or any other innovations that we can do, you see, broadly, one of the things that I think mutual fund industry tries to do is to offer simple solutions at scale. And sometimes simplicity leads to scale rather than too many complex features. To my mind, the industry has done two very interesting innovation over the last, let's say, a decade or two. One of them is a balance advantage fund, which allows people to sit through the volatility and allows us as fund managers to invest more money when the markets are lower. Our challenge in the past used to be that whenever the markets fell, investors would withdraw money. Now we actually have a situation where we can, if the market falls, I have a balance advantage fund, I can sell my debt exposure and move into equity, which is the best thing to do, which is the most sensible thing to do. So that's one innovation that has kind of worked well. The other innovation that has worked well is, of course, SIP, because that allows investors to invest with a long-term horizon. If you do a single ticket of, let's say, 1 lakh rupees, chances are every second day you'll get up and look at the NAV. But if you made an SIP commitment for the next 5 years or 10 years, and you manage to stay through that journey, irrespective of whatever the market has done through intermittent period, your outcome is going to be very good. All of us allow our PF to be deducted. All of us pay for LIC or any other insurance policy for 25 years without asking a question. Somehow, when it comes to investing in mutual funds or investing in the stock market, we start monitoring the price the very next day. So any tool that can help, let's say, refrain us or that can discipline us to taking slightly longer view on the market, longer term view on the market, automatically leads to wealth creation. And in that sense, I really compliment you, the entire distribution community, as well as all our investors who have taken to SIPs wholeheartedly, and I'm happy to see that part grow. Balance advantage is again a similar vehicle where you at least allow flexibility to fund managers to invest at a time when the markets are attractive and at the same time reduce the exposure to equity when markets seem overheated.
So one innovation for takeaway for all the retail investors is continue their SIPs, like you're continuing your EMIs and insurance premiums.
Absolutely.
Great, sir. Thank you so much for your time, Sureshji. It was a pleasure having you here on the channel.
Absolute delight talking to you, Sudhir, and wish you all the very best in your journey.
Thank you so much, sir.